Welcome to the 34th edition of the Entrepreneur series. It's Monday, the 8th of April 2024. In this series we will be taking a look at cost accounting concepts and cost-based pricing strategies for African SMEs. Introduction. Cost accounting is a fundamental aspect of business operations, enabling small businesses to make informed decisions regarding price setting for their products and services. This series will outline the concept of cost accounting and discuss its effective use in determining competitive prices for small businesses. Understanding cost accounting. Cost accounting is the process of gathering, analyzing, and summarizing information about a company's costs to determine its profitability and efficiency. It encompasses both internal costs and external costs, such as raw materials, labor, overhead expenses, and marketing activities. By understanding and analyzing these costs, businesses can gain valuable insights into their operations and make informed pricing decisions. Importance of cost accounting in establishing competitive prices. Cost accounting plays a crucial role in setting competitive prices for products and services for small businesses. By understanding the underlying costs associated with production, distribution, and marketing activities, small businesses can make informed decisions about pricing strategies. Analyzing cost structure. The first step in establishing competitive prices is to analyze the cost structure of a small business. This involves identifying the different cost categories, such as direct costs, indirect costs, fixed costs, and variable costs. By categorizing costs accurately, small business owners can allocate resources more efficiently and make informed decisions about pricing. In summary, the various commonly used costs components are: 1. Direct materials, the cost of raw materials used in the production process. 2. Direct labor, the wages paid to employees directly involved in the manufacturing process. 3. Overhead costs, expenses not directly associated with the production process, such as rent, utilities, and administrative expenses. 4. Selling expenses, marketing and advertising costs involved in promoting the product or service. 5. General and administrative expenses, corporate overhead expenses, such as salaries and benefits for administrative staff. 6. Depreciation, a non-cash expense that reflects the decline in the value of assets over time.
Fixed costs. Fixed costs are costs that do not change with the level of production or sales. They are typically incurred regardless of the volume of goods or services produced or sold. Examples of fixed costs include: 1. Rent or mortgage for office space. 2. Salaries and benefits for full-time employees. 3. Insurance premiums. 4. Property taxes. 5. Utilities, electricity, water, gas. 6. Maintenance and repair expenses. 7. Licenses and permits. 8. Debt repayment. Variable costs. Variable costs are costs that vary directly with the level of production or sales. They increase or decrease depending on the number of units produced or sold. Examples of variable costs include: 1. Direct materials, raw materials directly used in the production process. 2. Direct labor, hourly wages paid to employees directly involved in the production process. 3. Packaging materials. 4. Transportation costs. 5. Commissions paid to salespeople. 6. Advertising expenses. 7. Variable manufacturing overhead. Indirect costs. Indirect costs are costs that cannot be directly attributed to a specific product, department, or project. They are allocated based on some predetermined method or absorbed into general overhead. Examples of indirect costs include: 1. Rent or mortgage for production facilities. 2. Salaries and benefits for administrative and support staff. 3. Depreciation of fixed assets. 4. Utilities, electricity, water, gas, for shared facilities. 5. Indirect labor, employee time spent on administrative tasks. 6. General and administrative, G&A, expenses. 7. Insurance premiums. 8. Professional services, accounting, legal, marketing, etc. Calculating cost-based pricing. Cost-based pricing is a pricing strategy that takes into account all costs associated with the production of a product or service. It involves dividing the total costs by the total number of units produced to determine the per unit cost. By analyzing cost data, small businesses can determine the break-even point, which is the price at which the company can cover its costs and begin to make a profit. From there, they can set competitive prices that take into account the market demand, competition, and the desired profit margin.
Cost volume profit analysis. Cost volume profit analysis is an essential tool for small business owners to determine optimal pricing levels. This analysis helps businesses understand the relationship among cost, volume, and profit. By analyzing cost volume profit data, small businesses can identify the most profitable pricing levels, considering both fixed and variable costs. Break-even analysis. Break-even analysis is another critical aspect of establishing competitive prices. Small businesses can determine the point at which total revenue equals total costs, indicating the point at which the business starts to make a profit. This analysis helps businesses understand the minimum level of sales required to cover their costs and establish pricing strategies accordingly. Competitive pricing strategies. Small businesses can adopt various competitive pricing strategies based on their unique circumstances. Some common strategies include: 1. Cost leadership. Small businesses can strive to offer products or services at a lower price compared to competitors while maintaining a high level of quality. This strategy requires accurate cost accounting and cost control to maintain a competitive edge. 2. Differentiation. Small businesses can develop unique selling points or differentiate their products or services from competitors' offerings. This strategy requires a deep understanding of target market preferences and cost analysis to ensure pricing aligns with value. 3. Market segmentation. Small businesses can segment their markets based on customer preferences, demographics, or geographic factors. This strategy allows for targeted pricing strategies based on customer willingness to pay and cost analysis.
Using cost accounting to stay competitive. Cost accounting provides small businesses with valuable information that can enable them to stay competitive in the market. By monitoring and analyzing costs, businesses can identify areas of improvement and optimize their operations to reduce costs. This can lead to increased profitability and a greater ability to compete with larger companies. Additionally, cost accounting helps businesses understand their competitors' pricing strategies. By analyzing competitor costs, small businesses can identify opportunities to offer products or services at lower prices while still maintaining profitability. This allows them to attract customers and gain a competitive edge. Conclusion. Cost accounting is an essential tool for small business owners to establish competitive prices for their products and services. By analyzing the different cost components involved in production, businesses can make informed decisions about pricing strategies. By utilizing cost-based pricing techniques, small businesses can stay competitive in the market and make informed decisions about their pricing decisions. By continuously monitoring and analyzing costs, businesses can optimize their processes and maximize profitability. If you would like to know more, please get in touch on any of the social media handles below. All our content is developed from real-life experiences in a professional and entrepreneurial journey that spans across 8 countries and 4 decades. Quote of the week. Without strategy, execution is aimless. Without execution, strategy is useless. Morris Chang.